Today we deep dive into the world of LCs and bank guarantees, whether it's document examination under UCPDC 600. Dr. Ahmed, the floor is yours. You can start. You may start your session.
Mostly importantly, LCBG and co-acceptance of bills, spread or reduced interest, net interest margins, some operational aspects and the risk involved in it. It gives opportunity to earn the commission upfront, fees and exchange income. So it will be helpful in improving the net interest margin and also in improving the cost to income ratios of the banks. The first one is so it is not a main contract between the bank and the beneficiary. Whenever a guarantee is issued, it must be unconditional. There are various types of bank guarantees depending upon the location of the beneficiary, purpose, and various aspects. Whereas performance guarantees are issued for the performance of a contract or an obligation. So some of the performance guarantees are financial guarantees. The difference is very thin for retention money, warranties, indemnities, and standby letters of credit standby letter of credit related to particular transactions. These are all comes under the performance guarantee. Particularly guarantees in favor of shipping companies in to submit to the shipping companies in the absence of bill of lading. And we have to look into the bank guarantees that there should not be any onerous clauses. Will be done in within 24 hours or 48 hours with a proper approval from higher authorities along with the application. One is to adjust the margin money, and they got those contracts, they completed, and the bank guarantee is cancelled with a serial numbered covering letters in the banking industry. And every bank guarantee should have a limitation clause. Our liability under this bank guarantee shall not exceed rupees so and so. We are liable to pay the guaranteed amount or any part thereof under this bank guarantee only if you serve upon us a written claim or demand on or before for which there were adverse. The beneficiary is having the time up to 30th June. From our point of view, it is a genuine reason. Then invocation of the guarantee. So these are the important. Then there is a bank guarantee called deferred payment guarantee. As it is nothing but payment like sanctioning a term loan, the appraisal whenever we do. So for assessing the regular bank guarantee limits, there are various factors we have to consider. The borrower may also require guarantees for import of capital goods and concession import duty under various schemes of the government. Sometimes even hotels. So for that, releasing the advance payments or mobilization advances, the government wants the bank guarantees. Such guarantees also, whether it is required or not, we have to look into it. To arrive the bank guarantee limit and the anticipated value of successful tenders expected to be obtained, there may be some BGs, performance BGs and all, which we have given, they may get expired. So what is the amount of BGs expected to be expired during the year we have to obtain? These are the various bank guarantee requirements and various information we have to obtain from the. So how we will bid bond guarantee required for tenders is 5%. So 5% of the 400 is 20 crores. Estimated success rate as per his experience is, as I said, bank guarantees are non-fund based limits. These are issued by, it is practically very, very important cancellation of the expired bank guarantees at field level because as for maintaining the capital CRAR, because it also attracts the risk weight and our capital become idle. So though the bank guarantees are non-fund based, we have to conduct a proper credit appraisal of the applicant enhanced due diligence. We have to obtain adequate margin, so, and also collateral security. Most of the time, operational risk arises due to errors in drafting. Wherever the high value bank guarantees are there, they should be very thoroughly, due diligence has to be done, and also monitor very carefully. And also, when the contractor fails to perform, the performance risk arises. So we may be forced to pay the amount immediately. So whenever we are issuing the performance guarantees, we must assess and evaluate technical and financial capability of the contractor strictly as per the terms and conditions, ensure clear understanding of unconditional and conditional guarantees, maintain transparent and timely communication with the beneficiaries. So, friends, bank guarantees are no doubt contingent liabilities. Bank guarantees represent banks' reputation and financial commitment. So, making the credit appraisal while we defining the bank guarantee, we said our defaults, we we were promising to make good the amount in the bank guarantee. Whereas in letter of credit, it is a direct undertaking by the issued bank. Then what is the need of a letter of credit? The LCs play a major role in this transaction of buying. For the what are the advantages for the seller? Obligation of the buyer's bank for payment. He need not bother about the buyer's capability to pay. Beneficiary, issuing bank, and advising bank. These four will be there. Beneficiary party is the seller or exporter, other bank to confirm the letter of credit and guarantees to undertake the responsibility of payment or negotiation acceptance under the credit. So, in some LCs, we may state, as far as the negotiating bank is concerned, we can specifically stipulate also this LC to be negotiated by so and so bank, that is Citibank, New York. So, these are the various parties. The advising bank will verify. It may be also a confirming bank also. So the advising bank will payment at site and payments with issuance period. If it is payment and the documents will be delivered and those documents will be submitted to the shipping companies and goods will be delivered, and on the due date the importer is supposed to make the payment. Then there are two types of letter of credit with the deferred or issuance LC or site LC, that is considered as a recourse LC. The confirming bank's liability is similar to the issuing bank, that is second beneficiary, or number of parties, all are called as second beneficiaries issued. Suppose a LC is in favor of X, then red class letter of credit and a green class letter of credit. A green class letter of credit, whenever there is a, as I said, whenever there is an agreement entered between the buyer and seller, besides regular customer financial standing, line of business, due diligence, frequency of imports, sales, account turnover, satisfactory track record of the importer for goods, etc. are also mostly for capital goods, machinery. So how it will be assessed? Suppose a site LC limit required is about 48 crores. Guided are subject to uniform customs and practice for documentary credit. So UCP 600, all credits under UCP 600 are irrevocable, except as otherwise provided by Article 38. A credit can neither be amended nor cancelled without agreement of issuing bank, confirming bank, and the beneficiary. If the nominated bank, cover note issued by brokers will not be accepted. If the presentation is made, transferable credit. So friends, this is the UCB DC 600, standardizes the global LC operations, ensures predictability and uniformity in trade finance. Banks must focus credit risk. Importer may fail to reimburse the issuing bank after payment under LC. So proper mitigation is proper credit appraisal of the applicant, adequate margin and collateral security, regular monitoring of customer exposure limits, then documentary risk, country and political risk, political instability, foreign exchange restrictions or sanctions may affect the payment. So assess the country risk ratings important. So letters of credit no doubt reduce the payment risk in international trade, but banks must carefully manage credit documentary operational country risk through robust controls, proper documentation, adherence to the international rules as per UCPDC. Here, the parties involved are dryer, that is seller or supplier goods. Dry is the buyer of the goods. Bank, co-accepting bank is the buyer's bank guaranteeing the payment. Discounting bank, the bank that discount the bill for the seller. Buyer to the buyer, seller to the buyer. Seller draws a issuance bills of exchange on the buyer, discounting bank, and it recovers from the buyer. Ensure by verifying the invoices that there is no overvaluation of stocks, and co-acceptance of bills drawn under its own LCs also should not operational oversight. It provides limited protection, encourage wider investor participation in corporate bond market. PCE may also be provided to bonds issued by municipal corporations subject to adherence to the directions and terms and conditions and statutory provisions of loans and advances being issued by Reserve Bank of India from time to time. So what are the silent features? The eligible bonds must have minimum pre-enhanced credit rating of triple B minus. The capital requirement is based upon the amount of PCE provided. The risk weight will be calculated based upon the pre-enhancement rating of the corporate bonds, non-performing. So these are the various guidelines, and other regulatory safeguards also has been stated by the Reserve Bank of India. That is, bond offer document must disclose the rating with and without partial credit enhancement, enabling the businesses to conduct transactions with great confidence while preserving the liquidity, continue to remain essential for bankers.
And I invite participants to share their questions or observations regarding today's presentation, serve as a great source of encouragement for them as well as for us. So let's move to the. Actually, I think he will ask in person. So after this,
because this is the latest guideline of the RBI. It will be effective from 1st April 2026. BIS has also come out with what is called counterparty credit risk. Like, but there are a lot of activities, banking activities, which is covered under banking activities. You take this product. Now, coming to the partial credit enhancement, this was discussed long back because, we have discussed at least n number of times about the development of the corporate debt market or partial credit enhancement and rating, whichever is lower, or for second developing the secondary market. But there was some drill.
Generally, the investors will not be attracted towards the company's bonds issued by corporates or anybody, municipal corporations or anybody, when there is the rating is a triple B minus bonds.
The whole problem
And
is, otherwise I have no issue. Issue is, thank you.
Farid sir, it has always been a pleasure listening to you. Yeah, I'll just, this is point number one, sir. So RBI guidelines says usually it is 10 years. Here what happens, some banks use this itself as a tool to thwart or delay the takeover process, saying that this clause is not acceptable. This clause is not acceptable. So bank guidelines is issued in the favor of X, and after, in the format itself, it says after 1 or 2 years, I should have the right to assign. And after that, after their part of the work is over, they would like to assign it to their own associate companies, maybe the Reliance Petroleum or whatever it is. So something called assignment clause. The beneficiary.
First point you tell me, just not the entire point.
Give an example.
Now when you are taking over, you are issuing a financial guarantee only to other bank. But as per the RBI guidelines, there is a provision that you can give a bank guarantee. But I think whether they will go, definitely, because insurance, they have.
So this one thing actually I want some clarification.
So fund-based will be balance sheet item, non-fund-based will be contingent liability.
Oh.
Wherever the bank guarantees are financial bank guarantees, the credit conversion is 100%.
Audience, please ask your question. Participants, please. And now, for those who wish to revisit today's learnings, please note that the full video recording and enjoy your Sunday. Thank you. Thank you so much. Namaskar.